This time last year, cafe manager Sue Park bought shares for the first time in her life, and she's made a killing.
I heard that even if you lost everything in shares, that's not the worst thing you would be worried about. Actually, the world is collapsing, basically. So
Her investments in banks, buy now, pay later firms and hard-hit travel companies are up more than 50%.
one of the things I hear is you have to do a lot of research. I've decided to go with blue chips, but ones that weren't very obviously evil to me.
She couldn't have picked a better time to buy. Panic selling had reached fever pitch as markets finally realised that coronavirus was here to stay.
It's been another shocker of a day on the stock market.
Equities down and down hard.
The Dow Jones in New York suffered its biggest sell-off since 1987. Then, the ASX 200 plunged nearly 10% during its worst ever trading day, losing $160 billion.
We were facing a situation that I don't think any of us in our lifetimes had ever contemplated, literally a total shutdown of world economies.
A week later, markets bottomed. The ASX 200 has jumped nearly 50% since then to its highest level in 12 months. The Dow Jones performed even better, up 76% since the crash. And Wall Street's tech index, the NEWSThe, has surged 94% since its COVID lows.
I mean, I've got friends that are just in shock and disbelief.
Penny Wong has been in the market for 3 years, and her portfolio is still down 20%, but she remains hopeful.
It's gone too far to actually sell and cut my losses. I've seen this before in 2008. At some point, they'll bounce back.
Some companies which have fallen the most from their peaks in 2020 include Flight Centre, Oil Search, Webjet, Woodside Petroleum and Qantas, as lockdowns meant people weren't driving or flying as much. Some of the biggest winners over the past year are PointsBet, buy now pay later firms Afterpay and Zipco, rare earth miner Linus, Nine Entertainment and the online retailer Kogan. Even one of Australia's most successful investors in the past decade, managing $100 billion worth of assets, has been stung by the COVID crash. In the last 12 months, Hamish Douglas's Magellan Global Fund has underperformed the market with a 4% drop in its overall value. He's invested in long-term quality stocks like airports, toll roads and utilities, which have taken a short-term hit from the economic turmoil.
Our fund has to hold 50% of its assets in defensive equities. Defensive equities have underperformed the markets by around 15 percentage points. That is the nature of our strategy. So whilst it would have been nice to have rotated all the money into sort of cyclical growth assets, we can't do that.
He's not alone. Many fund managers have also taken a hit in this volatile climate. But some investors who have outperformed the market are warning parts of it may be overvalued.
What worries me is retail investors, whether they'll be nimble enough to get out before there is a significant adjustment.
Markets have been volatile because investors are worried that economies might overheat, especially with trillions of dollars worth of stimulus flowing across the world. And that might cause inflation to spike, forcing central banks like the RBA to hike interest rates sooner than expected. And experts say if that happens, it could trigger a correction.
These things tend to come to abrupt halts, but they can go on for very long periods to that point of halt.
Until then, a taste of market success will keep Sue Park investing.
And we all know what to do next time there's a pandemic. David Chow there. The Reserve Bank minutes today argued that home lending standards remain sound, but for how long? UBS analysis of the banking regulator's data has found higher risk home loans were up significantly in the December quarter when measuring debt to income and loan to value ratios and interest only measures. Specifically, UBS says the share of new home loans with high debt to income lifted to a record high. Economist Warren Hogan says the data is not ideal.
Yeah, well, the APRA data certainly shows an increase in high-risk lending in the last 3 months of last year, but the levels of sort of risky lending are still in line with historical trends. But clearly, if the market keeps on strengthening, and I think importantly, if investors come into the market, then you'd expect to see high LVR and high debt-to-income lending potentially increase as a share of the market.
is that increase that we've seen? I mean, you say it's coming off a small base. The APRA data showing that it is starting to pick up. I mean, how worried should we all be about that? Is it at the margin or is it serious?
We're talking about 1 in 5 loans being regarded as high risk, but that's pretty typical as the market swings up in Australia in the last decade. The hallmark of the market pickup so far has been that it's been driven by owner-occupiers, which are typically at the lower risk end of the spectrum. If investors start to come back into the market with some vigour, that's when you're going to see an increase in higher risk lending, and that's when APRA will really start to look closely at the market. But they'll probably take until the second half of this year before they get to that point.
Yeah, and you're very much in the consensus on that point, saying that it's going to be later this year if we do see anything from them. I mean, it comes from the Council of Financial Regulators, APRA's in there, RBA's in there, but also the Treasurer. How keen do you think are they going to be to weigh into the housing market to dampen it down when all signs are that, and including from the RBA's minutes today, is that housing is really the only thing that's firing in the economy? I mean, business investment is still nowhere, and there's very little expectations that it will really start to pick up.
Yeah, and I think that's a really good point, because it is a housing-led recovery, and for that recovery to turn into a genuine upswing in the broader economic cycle, it needs to continue, and you need to transition from higher borrowing, higher secondary market activity into construction. The signal is being sent through higher prices to developers and others to build, but that's still well down the track. So there will be very little appetite to do anything right now. And indeed, if the market and the lending standards in the market remain reasonably well behaved by the standards of past upswings, then we may not see them act until next year.
Warren Hogan, thank you very much for your time.
Thanks, Elise.
Last week, the Biden administration signed the COVID relief bill into action, meaning it will spend $1.9 trillion between now and the end of the year. The key provisions of the bill are direct payments, a bigger child tax credit, checks for state and local governments, and billions for healthcare and vaccines. What will so much money do to the US economy, though, and to ours? And will it work? I spoke with Gail Fosler, who, among many roles, has been the chief economist of the US Senate Budget Committee and named America's most accurate economic forecaster. Gail Fosler, is this $1.9 trillion going to work, or is it even too much now that you've got an economy opening back up and vaccines flowing? Is it too much too late?
One of our concerns, based on our analysis, has been that this is going to be very disappointing in terms of restoring the employment levels to the pre-pandemic levels. We believe that the U.S. is entering, let's say, or at the beginning of another era of structural unemployment that we really haven't seen since the 70s and the 80s, such that a lot of the services jobs are really permanently lost, and the rate of increase in services jobs relative to jobs in transportation, mining, or manufacturing, and the like, is going to be much slower than it was in the last couple decades. So, I think there are people who expect you get this big fiscal shock, the economy booms, you get a lot of employment. We don't regard that as the case. We think that a lot of this is going to be saved. The savings rate went up to 35% in the second quarter last year. We should see another big double-digit increases in the savings rate this year, and maybe not this year, but certainly next year, a significant amount will go into inflation. That is, nominal income will go up, but real income will be disappointing, in our opinion. Now, you say, is it too much? And I really think it is too much, because I don't regard our borrowing authority, even if we are the foundation of the reserve currency, I don't regard our borrowing authority as unlimited. And we are going to test the limits of America's seigniorage, of America's capacity to borrow at unlimited amounts in the global markets.
So we've got the $1.9 trillion stimulus package coming, and then on top of that, there is an extra infrastructure package, which is what, around another trillion?
Another trillion at least. The bill that was passed by the House, which was $1.5 trillion. Now that is over 10 years. All right, that is over 10 years. It is probably going to be even larger than that, and I would think that we're looking at something upwards of 2 trillion. That's 200 billion a year over 10 years. Now that's distinct from the staggering amounts of money that are being spent this year, but still it's enough to catch your attention.
So to the knock-on to Australia, I mean, of course, iron ore miners are going to be excited about $1 trillion for infrastructure, but also our major investors. I mean, we brought asset recycling to the US, and clearly we'd be hoping we can do that again and purchase US projects for renewal.
Well, I should say that here in Montgomery County, they have selected an Australian infrastructure firm preliminarily to build the new toll road system that they're proposing. So you Aussies are very much front and center as beneficiaries of this infrastructure effort.
And so do you think that it's something that the Biden administration will be actively wanting to encourage with trade partners like Australia?
You raise a very interesting point, which actually has not been raised in the public discourse so far. And that is that, China has been very adept at, in the Belt and Road program, coming in with the dollars and indebting a lot of these countries, and then building the projects with Chinese companies and Chinese labor. You could imagine that the president could dovetail this infrastructure with partnerships with a number of the infrastructure firms. Now, he's very much a Buy America kind of guy, so you have to walk a careful line. But as long as these companies hire American workers, I think there could be a very interesting kind of international play embedded in this infrastructure, in these infrastructure proposals.
And of course, the big question for Australia's central bank in particular is, what is the Fed going to do with trillions of dollars being stuffed into the US economy over the next 2 years?
I mean, the Fed is going to continue its highly accommodative and you might even call it interventionist policy until it's really brought to heel by international markets and international and long-term interest rates. The Fed and the Treasury may deal with the interest rate, the normal market interest rate effects of all this stimulus that you're seeing is to cap long-term bond rates from a regulatory point of view. This is, long-term bond rates were capped at 4% until 1969. But the notion we could go back there because we feel that that there's a compelling reason is quite possible.
Gail Fosler, it's been great to chat with you.
Well, Elisa, good luck to you.
To the markets, which leapt to their highest level in 3 weeks, the dream run continues. The All Ords and ASX 200 added 0.8%. The Aussie is buying just over 77.5 US. And that's all from The Business. I'm Elise Morgan. Good night.